If you've inherited a house and you're worried about paying a massive capital gains tax, let me give you some good news. Most heirs in Texas owe very little or none at all. Let me explain why. My name's Nate Clark. I'm a probate-focused real estate agent here in Austin, Texas, and I help heirs and executors sell inherited property every single week. One of the biggest fears I hear from heirs is that I'm going to get crushed by property taxes when I sell this property because my family bought it for so much less than it's worth now. But inherited property is treated very differently from other property types. In most cases, heirs benefit from something called stepped-up basis. So I've made another video about stepped-up basis. In plain English, stepped-up basis means that when somebody passes away owning real estate, the value of the house for tax purposes is reset to what the fair market value was at the time of death, not when they bought the property years or even decades ago. So if your parent bought the house for $100,000 and they passed away last year after owning it for 20 years, if the fair market value was deemed to be $500,000 at the time of passing, you'd actually only pay capital gains on the gains over $500,000. So if it sells for $600,000, you're not paying the difference of $100,000 to $600,000, you're paying the difference of $500,000 to $600,000. So typically, if you sell it shortly after that parent passes away, you're paying little to no capital gains taxes. Now, capital gains taxes can come into play in a couple situations. One would be where you hold on to the property for a long time after the family member passes away. The other would be if you do significant improvements. Then the third situation would be selling it for significantly more than the stepped-up basis value when that family member passed away. So in those situations, you may owe capital gains tax on the increase after inheritance, but not on the total value of the property, and that's a really important distinction to make. Now, here are a few common ways that heirs avoid or reduce capital gains tax exposure, always to be used in conjunction with a CPA or tax professional. Number one would be selling the property shortly after inheriting it. Two would be using the stepped-up basis properly. Three would be keeping good records of the property's value at the time of death. Number four would be accounting for selling costs and improvements, which can actually reduce your capital gains tax exposure. This is why timing and documentation matter so much. Some heirs ask, but what if I move into the house first? In certain situations, living in the home may actually create additional tax benefits, but this depends heavily on timing and individual circumstances. And this is where you absolutely want professional tax advice because doing this wrong can backfire. Now, I want to be very clear. I'm not a CPA. I'm a realtor. I don't give tax advice. But I work alongside probate attorneys and tax professionals, and I see these situations play out all the time in real time. The biggest mistake that heirs make is assuming that they'll owe a massive tax bill and then making rushed decisions because of fear. If you've inherited a property and you're deciding whether to sell it, keep it, or rent it, understanding capital gains plays a huge role in that equation. If you're in Texas and you want to understand how the real estate side of this works, I do this all the time, and I'm happy to walk you and your family through how this applies to your individual situation. All of my contact information is down below.